Shares of Starbucks Corporation have staged an impressive rebound after a sharp decline this year. The stock has risen about 25% since mid-June, in slow but steady gains still. The global coffee chain remains one of Wall Street's worst-performing multinational restaurant operators this year, underscoring the many short and long-term challenges it faces. Notably, the latest earnings report should help the company's rebound. As it suggests the worst may be over, the coffee chain giant reported on Tuesday that its sales in North America remain strong despite the company raising prices several times in response to rising costs. In the 3 months ended July 3. Starbucks global same-store sales rose 3% from a year earlier, and U.S. same-store sales rose 9%. Cost per unit rose 6%, but comparable transactions fell 3%, suggesting higher prices compensated for lower volumes. While consumer demand in North America is showing strong trends, Starbucks sales in China, its second-largest market, remain sluggish. Starbucks sales in the region plummeted 44% due to COVID-19-related restrictions. The decline beat analysts' expectations of 39%. Despite the recent rebound, Starbucks' upside potential remains limited given the many uncertainties surrounding the coffee chain, the biggest of which are management uncertainty, labor disputes, and where the pandemic is headed. Company founder Howard Schultz returned as CEO in April as a stopgap solution to the company's ongoing problems. However, he then suspended his share buyback program, citing his need for cash for stores and employees since taking office. Howard Schultz has been reshuffling management and trying to undercut America's growing union movement. 184 of Starbucks' 9,000 stores are unionized. 54 stores are conducting union elections. Howard Schultz said on a conference call with analysts that Starbucks has a reinvention plan that will affect every aspect of the business, with details expected to be released at its September 13 Investor Day. It's worth noting that Starbucks is already dealing with an unfavorable macro environment, and these uncertainties have only exacerbated the problems facing the company. Starbucks' profit margins have been squeezed as U.S. domestic inflation hits its highest level in 40 years. As well as the Russian-Ukrainian conflict and rising food and coffee prices, despite Starbucks' strong brand and expansive economic moat, management changes. Inflationary pressures and uncertainty about the company's new direction have made people less willing to own the company's stock, and a survey of 34 analysts showed that half of them do not recommend buying the stock. With their consensus price target implying that the stock will be only slightly up from current levels overall, Starbucks stock will continue to face a challenging operating environment with limited potential for further upside. Investors are better off staying on the sidelines until Howard Schultz charts a new direction for the company and the Chinese market fully opens up.